From a big picture perspective, we're actually quite cautious. There are a number of reasons for that. Growth globally is lackluster. The growth has been anemic in all key regions, even in the US, and obviously China is now slowing quite rapidly. Secondly, interest rates are low, but they're expected to rise, and they will rise. The Fed has already indicated that rates will rise later this year or early next year. Finally, valuations are high. Equity valuations are high relative to history, and clearly there is scope for de-rating going forward. So from a macro picture, we're cautious. But take a step back from the macro and start looking at individual companies and individual businesses, and the picture looks much better. And we're particularly focused on areas where there is scope for earnings surprise. A couple of examples. Disruptive technology is an area that we see a lot of opportunity in. There are new companies with new business models that are shaking up legacy businesses and creating very strong revenue and earnings growth that we think will continue and indeed accelerate over the next 12 months. Secondly, innovation and pricing power. We're big believers in innovation. Innovation creates pricing for companies. Companies that do innovation well generally generate strong earnings and revenue growth for their shareholders. So we're very focused on innovation and companies that can do it consistently. Finally, self-help is an area that we believe is very important. There are a lot of legacy companies that have very slow revenue growth, not much top-line growth. But actually the good ones are addressing that by cutting costs, focusing on the balance sheet, and delivering earnings growth to shareholders through that careful management of the assets that they have. So again, an area of opportunity that we think the market is underestimating. Overall, the picture from a stock perspective is actually good. The pipeline is strong and we're excited.